Hey everyone, it's Phil here, and welcome back to the Deep Dive. Today, we're going to be diving into a pretty cool option strategy that has the potential to maybe generate a little bit of passive income and give you a chance to buy stocks at a discount.
I don't know if you're allowed to do that.
Now, it might sound too good to be true, but let's unpack this and see how this strategy really works. It's called cash-secured puts. So let's just start by demystifying, what a cash secured put actually is. So imagine this, right? There's this really cool vintage video game console you've had your eye on for a while now, and it's going for about $200. But you're hoping to snag it for a bit less, maybe around $180. Now, instead of just buying it right away, you kind of propose a deal to the seller. And you say hey, I'm willing to buy this console from you for $180 if you still have it in a month. And to show you I'm serious, I'll give you $10 right now for the option to buy it later. So that $10 that you paid up front, that's essentially the premium in a cash secured put. You're essentially saying hey, I'm willing to buy this at a certain price, which is called the strike price, if it hasn't sold by a certain date, which is called the expiration date. So let's bring this analogy into the stock market. Instead of a video game console, we're talking about shares of a company. Let's say it's a company like, I don't know, Zoom. You've been thinking about adding Zoom to your portfolio, but it's currently trading at $100 per share. Now, instead of buying those shares right away, you could sell a put option with a strike price of, let's say, $90 and an expiration date a month from now. If you do this, you receive a premium up front. Let's just hypothetically say the premium is about $50. Now, this $50 is yours to keep no matter what happens next. So what are the possible outcomes here? Well, if Zoom's share price stays above $90 by the expiration date, that put option expires worthless, and you get to keep that $50 premium. And guess what? You can sell another put option if you want, so you're kind of getting paid to wait for a potential bargain. But what if Zoom's price dips below $90? Well, the buyer of the put option would then exercise their right to sell you those shares at $90, which means you'd be obligated to buy those shares even if the market price is lower. And in the options world, this is called being assigned the shares. Now, at first glance, this might seem like a bad thing, right? Like you're buying stock at a potential higher price than the current market value. But remember, you were interested in owning Zoom anyway. And now you're getting it at a discount compared to that initial $100 price tag. Plus, you've already pocketed that $50 premium,
Cha-ching.
which helps offset any potential losses. So why are cash-secured puts often seen as a great tool for generating passive income? Well, let's break it down. First, you receive that premium payment up front. This is different from something like dividends, which are usually paid out quarterly. Second, if you were assigned the shares, you're essentially buying a stock you already wanted, but at a lower price than you might have originally paid.
Pretty good.
And here's the interesting part. This process can be repeated. If that put option expires worthless, you have the opportunity to sell another one, so you could potentially be collecting more premium while waiting for the right time to buy stocks that you believe in for the long haul. It's like a cycle. You can just keep going. But hold on, before you jump headfirst into the world of cash-secured puts, remember, no investment strategy is without risk. Cash-secured puts do have their own set of considerations, and it's important to understand those. So the biggest risk with cash-secured puts is that the stock price just, takes a nosedive and plummets significantly below your strike price. So let's go back to our Zoom example, right? Remember, you sold a put option with a strike price of $90. Now imagine Zoom's share price just drops, dramatically falls to I don't know, $75. If this happens, you'd be forced to buy those shares at $90 each, even though they're currently trading for much less. Now, that $50 premium that you received would certainly cushion the blow a bit, but it's still important to remember that you could end up owning shares of a company at a price that's higher than the current market value. That's why it's absolutely crucial to only sell puts on stocks you genuinely want to own and have confidence in. Think of it this way, right? You're essentially acting as an insurance provider for another investor. You're taking on the risk that the stock price might fall below a certain level. In exchange for taking on that risk, you're receiving a premium. But just like an insurance company wouldn't insure a rickety old car without carefully assessing the risks, you shouldn't sell puts on companies without doing your due diligence. So how do you manage the risks associated with cash-secured puts? Well, there are a few key strategies. First, focus on companies with solid fundamentals. This means looking at their financial health, their management team, their competitive position within their industry, and just their overall track record. Think of it like building a house, right? You wouldn't build a house on a stakey foundation. You want to make sure it's built on solid ground that can withstand storms and the test of time. Same applies to investing. You want to choose companies that have a strong foundation and are likely to kind of weather market fluctuations. Another important strategy is to sell puts at what are called support levels. So think of a support level like a safety net for a trapeze artist. It's a price point where the stock has historically bounced back from dips in the past. By selling put at these levels, you're increasing the likelihood that the stock will stay above your strike price, which in turn reduces the chance of you being assigned those shares. Now you might be wondering, like, how do I find these magical support levels? Well, that involves a bit of technical analysis. You can look at charts of a stock's price history and look for patterns, trends, and those points where the stock has consistently found support in the past. There are tons of resources available online and through your brokerage that can help you learn more about technical analysis. But remember, no matter how much research you are, there's always a chance that the market will move in unexpected ways. That's why it's essential to manage your risk by only using funds you can afford to lose. And by diversifying your portfolio, don't put all your eggs in one basket, right? So in the next part of our deep dive, we'll explore some additional risk management techniques and address some frequently asked questions about cash-secured puts. So one question that I often get is like, what happens if I get assigned the shares, but I don't really want to hold on to them for the long term? Well, you always have an option to just sell those shares on the open market. Keep in mind, though, that if the stock prices drop below your purchase price, you might end up selling at a loss. Another question that often pops up is about managing those situations where the stock price just really plummets after you've sold a put. So what do you do then? Well, one technique is called rolling your put options. It's kind of like hitting the snooze button on your alarm clock. You're giving yourself a little bit more time. So essentially, rolling involves closing out your existing put option before it expires, and then simultaneously selling a new put option with a different strike price or a later expiration date. This could be a useful way to adjust your strategy as the market changes. So for example, let's say you sold a put with a strike price of $90, but the stock price drops sharply to $70. You could roll your put down to a lower strike price, maybe $65, and perhaps push the expiration date out a bit further. This could potentially reduce your loss if you end up being assigned those shares. On the other hand, if the stock price rallies significantly, you could roll your put up to a higher strike price, potentially increasing your premium income. It's all about adapting to the market's movements and managing your risk effectively. Now, before we wrap up, I want to emphasize one crucial aspect of successful investing, and that's thorough research. Never rely solely on what you hear or read, even from sources you trust. It's always best to do your own due diligence before entering any trade. That means, understanding the company's financials, looking into industry trends, analyzing the stock's price history to identify those support levels we talked about earlier. The more informed you are, the better equipped you'll be to make smart investment decisions that align with your goals and your risk tolerance. And that brings us to the end of our deep dive on cash-secured puts. I hope this exploration has given you a solid understanding of this versatile option strategy. Remember, cash-secured puts can be a powerful tool for generating passive income, potentially acquiring stocks at attractive prices, and navigating the uncertainties of the market. But like any investment strategy, it's not a magic bullet. It requires patience, discipline, and a commitment to continuous learning. If you found this deep dive helpful, don't forget to like and subscribe for more insights and explorations into the world of investing. I'm Phil, and until next time, happy investing.